Good morning, everybody. Welcome to the Flow Show. Welcome to a new week. After a busy week, this week's going to be the most important week since last week. Morning, Stel. Morning, Kay.
Good morning, everybody. Hello.
How you doing, guys? Have a good weekend?
Yeah, I ate a lot again. I need to stop that.
Yeah, you might put on weight.
Yeah, how about you?
Yeah, a bit of a quiet one. Taking down all the Christmas decorations, tidying the house, doing the year-end accounts. Yeah, lots of interesting stuff for the first week of the year.
Yeah.
So,
Well, we
yeah,
get CPI this week. It's going to be mega important. Most important print since the Second World War. I think. No, I'm kidding, obviously.
Friday. Since last Friday. Most important print since last Friday.
Yeah.
How about you, Kay? You had a good weekend?
Yeah, pretty much similar. Started to take off the Christmas decorations. Yeah, nothing really very special.
Yeah, just taking it easy. Well, as Stel mentioned there, we have got, well, I say we got a busy week. We've got a busy day next week. The data is always usually quiet the week after NFP week. That's when we get the bulk of the data. As you can see from the calendar there, not a lot of data out today, well, through until the CPI data, US CPI data on Thursday. That's going to be the big number. However, tomorrow there is a big do at the Riksbank. They've got a big symposium on central bank independence, and all the big hitters are there. Powell's going to be there on a panel. We've got Kuroda, Macklem, Bailey, Kuroda. Have I mentioned him? I might mention him twice. So a big event tomorrow. Now, the subject being central bank intervention, central bank independence, doesn't lend itself.
There is none. So basically, what they're going to be talking about. Sorry.
Talking about how their Christmases were. Who got the better gift at Christmas? But yeah, that's the subject. So it's not leading itself to the fact we may get tons of monetary policy comments, comments on the economy and stuff like that. But it's a risk event nonetheless. So that runs through the bulk of the day tomorrow. So just be aware of that. That's upcoming. If you're on the ForexAnalytix platform, I've put the whole schedule in the news and research room, so you can check that out there. But otherwise, the data, as mentioned, not a lot out. Friday, we get some CPI data from France, a bit of data, industrial production from the UK, GDP stuff. In the afternoon, we get the flash number for the Michigan consumer sentiment. That's about it. So data-wise, very quiet. And so I think all eyes are going to be on that CPI report coming in on Thursday. Moving across to some of the headlines, China moving further into this new COVID phase. Bit of a brushing it under the carpet now. They're saying that China's basically got to live with what's happening with COVID. So that's continuing. China has a big festival coming up towards the end of the month, the Spring Festival, they call it. They're expected to see a lot of traveling going on over that period. So it could be something that we hear maybe if there's really sharp outbreaks, some travel gets restricted or areas locked down. But otherwise, it could also lead to a pickup in the wave of COVID cases sweeping across. But for now, everything looks like it's going to continue as normal, and they continue to prop up the property market as well. Over in Japan, Kishida is still banging on about what's going on with the Bank of Japan. He has vowed to debate with the government, the Bank of Japan, the roles with the new central bank head when he comes in April. And the BOJ and the government must work together for price stability. He also calls for a dialogue with markets on the Bank of Japan's policy outlook. He wants the Bank of Japan to be a bit more open in communicating potential moves to markets and the like going forward. The opposition leader has called for a more flexible Bank of Japan policy. The opposition is very much in the minority in terms of ever likely to get in, but those calls are there nonetheless. But once again, we're getting this stuff building up regarding Kishida and what's going to happen to the Bank of Japan as we enter into the new year. So that cauldron is going to keep bubbling. Over to the ECB, Centino last week said rates are close to peaking if there's no further external shocks coming in. Excuse me, let me shut my squawk off. Here we go. So he's not very hawkish, is old Centino. He's a bit of a dove. So he says rates are close to peaking when it seems they're going to be hiking continuously further forward. He said today's inflation data are quite positive, as they speaking on Friday, that was. ECB's Lane also last week said if there was a recession underway, it is at the mild end, and that everyone should expect a fairly big drop in inflation this year. BOE's man said that the energy price caps may be lifting other inflation. So what they're halting on one side is being passed across on another. So just to quickly go back to the data that we had last week. Obviously, the non-farm payrolls was big data last week, but that wasn't all. We had quite a bit. I can find out where we are. Where are we going? No preparation, Ryan. Here we go. Let's get in there. So we kicked off with the NFP last week, obviously. A big, strong number, first and foremost. On the headline number, coming in at 223K versus 200 expected. So no real risks or shocks coming in there. We also saw the unemployment rate dipping quite significantly, 2 points to 3.5% versus 3.7% expected, and the prior revised down as well. But what kicked the market really off was the wages number. These average hourly earnings coming in at 4.6%, so a miss there and revised down from last month as well. And that is really what the market jumped on board with last week, because I thought overall the data looked pretty positive. The soft landing looked even better. That unemployment rate came down even after the participation rate ticked up, which is a negative pressure for the unemployment rate. So it was a double positive there. But those wages data, that really got the ball rolling in what we saw in markets. And then that was followed up afterwards by the ISM, painting a slightly different picture. Employment there going into contraction, new orders heavily into contraction, the index itself a big dip into contraction as well, prices paid continuing its dip down, 67.6. So all negative numbers there, positive if you want inflation lower, but negative on the activity front there. And you know, so on one side we got this strong job still, on the other side we've got all the other indicators pointing towards negativity and a slowing economy in the US. Now, obviously on Friday, it was, well, all last week, I would say, it was a bit of a roller coaster up and down. I think perhaps maybe there was too much shoved into 1 week of coming back from the new year, everyone repositioning, a lot of big data in that week as well, everything going on with central banks and the like. And I think, yeah, perhaps that we just saw too much volatility going on. I mean, that, you know, we got this move on Friday after the NFPs. At one point, dollar yen's touching new highs, and next point, it's hitting new lows. So a bit of a crazy week all round. And that came really as, you know, yields took another bath. I mean, we were looking like we were moving up towards, you know, 380 at one point during the week. And then the NFP data came out, and wallop, we took a knock on the head once again. What are you making of it, guys? It seems, I don't know, a bit of a crazy week, as we all knew it would be coming back for the new year. But I'm still not sure which way people are setting their stalls out, apart from getting back to what things were like before we hit the holiday period. What are your guys taking it?
Well, for me, it's the market still trying to fight the Fed. I mean, this is what seems to be happening. The Fed keeps telling us that we're probably going to be hiking a little bit more than markets expect, and we're going to stay at that level for definitely a lot more than the market expects. But last week's numbers, yes, the headline number in NFPs was still pretty decent, but average earnings was lower. And then, like you said, PMI, non-manufacturing PMI was weak everywhere. So the data we're getting is slowly pointing, or not slowly, maybe a little bit more fast, but pointing towards potential recession coming, and so this is something that will drive the Fed to change its tune, but we may not be there yet. We have Powell speaking tomorrow, right? I think he's speaking tomorrow, and we have CPI on Thursday. So for now, with the market going again this much, it's one-sided, right? We're still going against the Fed, still trying to tell the Fed, no, we don't believe you, you're going to be cutting by late this year. There is danger with that. It might well turn out to be right. The Fed might be cutting late next year, but I just think when I see the market going this much one way, it's just dangerous. Now, having said all that, I've said repeatedly for months now that I think late Q1 of this year, we're going to be seeing inflation dropping very, very fast. And I think we've already started. I mean, we've definitely already started. I didn't expect it to be dropping as quickly as it has so far. Now we're seeing from 1 month to the next, year-on-year inflation dropping by a percentage point, in the US, in Eurozone. It's already starting. And I think as we get to the point where we're comparing prices to last year, so year on year, comparing to February, March, April of last year, when we saw the big jumps happening. I think the rate of change is going to drop dramatically. So eventually, I think with inflation going down fast, the Fed will stop, right? And they will change their tune. But I just feel like the risk is increasing quite a bit for a counter move first. So the whole market going towards one side of the boat, and everything gets really concentrated in terms of positioning, and we get a little bit of a surprise. Then, we reprice quite strongly at some point the other way. But as I said before, I think my main scenario is that inflation does drop and that the Fed does pivot. I just feel like there's a big increasing risk of a move the other way first.
Yeah, no, agreed, mate. Agreed. Kay, what are your thoughts?
Yeah, well, I mean, I have to agree with the both of you, and as we were saying last week as well, first week of the year crammed with some data, probably the big players not yet back online, but I have the feeling still selling dollar rallies for now, like trying to prepare for Fed pivot, or as we have seen, the negative numbers getting a much bigger impact than positive numbers. When you compare the NFP to the wages and then the ISM non-manufacturing index. So yeah, a lot has been done, and then assuming that this is the first week, or of course we got CPI, and then we got all those speakers tomorrow, so there could be another week of very big ping pong games, or I want to be this side or I want to be that side. But if you say euro is still on the stronger hand, I would say, because if you look at even at the yen cross, for instance, euro yen is trading still pretty well beat. If you take out the real yen move, euro yen is relatively beat. We've gone up 4 big figures from the lower already. If you look at stuff like euro sterling, still around 88, so higher than the average of last year or the last few months. In the short term, it's really doing a ping pong. But yeah, the euro is hanging, but the rest is like really trading volatile, but within a certain range. So and on, if you look at the US 10s, for instance, we're back to where we were before year end.
Yeah.
You look at the half deck, somewhere there, we were turning around 360, coming back from the 340 level. Then we went down a bit, and then we had this big rally towards year end, and now this has been like undone, and now we are back to somewhere square one, you know.
Yeah.
And as Telio says, in CPI this week is probably going to provoke a big move again. But then, if I look at how the whole picture unfolds, is that that last big domino, the NFP and the jobs are still holding up. But then, interestingly enough, is that BLS said we were going to have the revisions for last year coming out in the next report, I guess. And that should create another big event, in my opinion, because the market is going to scrutinize at how they are going to come out comparing to what the household numbers saying for a lot less job creation. So for the time being, I'd say we're still in a ping pong move and big up and down swings. And to be fair, I have a bit of trouble to see the long-term picture through the short-term trees right here and now. We had the big rally in the dollar last year. We had the big correction in the dollar end of last year into the turn. Now what? And I don't really know what the next step is. So for me, I'm still very much looking at the shorter term picture, because I still think the dollar isn't dead. Even if inflation comes down, it's probably going to come down elsewhere as well. We have seen in the Eurozone that we are starting to print lower numbers. Well, Japan is still catching up on the other side, but we'll see what happens there. Yeah, the moves, the yo-yo is ongoing, and I still have a bit of trouble to know what the longer term will be. If inflation comes down and the Fed needs to pivot, of course, the dollar is going to get another knock on the head. But how much has the market already anticipated this move? That's always my question. Euro dollar is 10% from its lows. Well, cable was a bit of a different story with Truss and Boateng in the mix, but we're above 120, where we have been trading sub 110. Dollar yen is low 130s, where we have been trading 150. So the dollar has already corrected quite a bit. And my question is, how much further a real trend? I mean, how much further do we have, or can we go? But we will have to see currency per currency versus dollar, because as I always say, I mean, you've got the dollar on the one hand, but we have to take into account the sensibilities of or the sensitiveness of every other currency versus the dollar as well. Like for cable, for instance, I'm a little less supportive than I would be for our euro dollar, for instance, because the ECB is catching up, and we've seen the first data coming out of Euroland are not as crappy as they could have been expected. We're also seeing energy prices coming down, so somewhere the euro, in my opinion, could come out a little better of the whole event than some of the currencies.
Yeah, and I agree with you guys. I think there is a big risk of the Fed pushing back against it. I think the key aspect we've got to watch for is this financial conditions talk, and how their hike path is being translated into the real economy. That's on the soft side at the moment, as many have commented on. So I think, even if we get a higher CPI number, I don't think it's going to last. Any rally we see in yield, any rally we see in the dollar, I don't think the dubs and the pivoters are going to drop this bone too easily. So from where I sit now, I see any dollar rallies as something to look at, potentially to sell. As you guys and girls know, I've been bearish the dollar in the latter part of last year, positioning that way. and I see no real reason to change it. But as Kay mentioned, you got to look at different aspects as well. You look at dollar yen. Yeah, it's gone a long way, but that hasn't all been the dollar. It's been a lot of yen in there as well, and expectations for the Bank of Japan. So lots of puppet strings being pulled around these different pairs. But yeah, as I sit here, as I say, I think I've got no reason to change my bearish dollar mood at the moment until such time as Stel says maybe things get pushed a little too far, which they may be getting that way now, or the data comes out to change it in a different aspect. But let's get back to just a couple more headlines, because Bostic was out after the data and the reports last week, saying that his outlook on the economy remains unchanged after the jobs report, and the Fed still need to stay the course as inflation is too high. Sees rates rising above 5% in this year, between 5 and 5.25%, and then needing to hold there and let that policy rate grip the economy. They need to stay at the rate peak well into 2024, and says there will not be a lot of urgency to cut rates. Now, he also hinted at what his measure for the January meeting is, and that's the holiday shopping numbers could influence the decision if consumers proved more or less resilient over this holiday period. Now, looking at the Fed pricing after the data and coming into this morning, we now increased probability of a 25 pip hike to 75% versus 25% for a 50 basis point hike at the next meeting. So that's again showing you which way the market's leaning. If we go too far towards a 25 pip hike or continue to go that way, that's going to put the big price risk on if they go a 50, as I think they will do anyway. That could cause a little bit of repricing coming in over that FOMC, but a lot of water to go under the bridge until we get to that meeting. And staying with jobs, Goldies are going to cut around 3,200 jobs this week after a review of costs. So banking not going to miss out on the job cuts like we've seen in the tech sector as well. So looking at some of the moves that we've got going on, as mentioned, yields really dipping back again, particularly on the 10-year. And I don't know if you remember before we hit the holiday period, I did say you need to take a snapshot of things after we had all those central banks and that busy week up to Friday the 16th. Take a snapshot of what was going on in the economy, what was going on in the fundamentals, because that's what we're likely to get back to when we get into the new year. Now, we've had all this messing around. Remains to be seen. We're near those levels, or have been near those levels that we were at the end of that week. The market is still trading dovishly on the Fed. The data is still softening. The jobs market is still the bright light and the only one that hasn't really turned yet, although we have seen negativity or contractions in pretty much all the PMIs regarding employment. So could be a lag to come. We could see something happening over the next few months if that stays as its current trend in terms of job metrics in other areas. It may be that the NFP is on borrowed time. I will repeat again that when we get the Jan numbers for NFP, look out for that weather shenanigans potentially coming in because of all the winter storms in the US affecting how they produce the reports over there. But looking at some of the other pairs, Aussie dollar finally made the break above the this 670, 68, 70, 80 area. Breaking through the FA.C.E, breaking through 69. At the moment, we are trying to hold on to 69. Just had a little test just a moment ago. We're holding that 69 big figure for now. That's going to be the first marker. If we can hold above 69, that should keep this break in play. If not, I'm going to be very concerned if we get back under 68.70, this broken high. This is going to be my line in the sand. I was looking at potential break trade last week, but I didn't fancy going with buy stops because I was worried, going in at something like 69.20, how much further upside there would be on a break. And, we got up to near 50. before coming back. So I would have probably had a buy stop in at 69.20, something like that, and it wouldn't look too hot right now. So I'm going to use this 68, 70, 80 area as potentially a place to try a long from, try some for a short-term play to see if the break is maintained, then fold some into the core long position to carry on running further. What I did do this morning was knock a tiny bit off my long-term position, 69.30s, just to put some in the bank. If this break does fail, then at least I've taken some profit. But that's how I'm going to play this area at the moment. One other pair that it's been absolutely battered, really, is dollar China. It's really taken a beating, gone through all the tech levels we were looking at here. This fib 684 was a bit of a support resistance area, as you can see there. Back May earlier this year, it was one of the big levels we banged our head on before making the break above. Then soon after, we found it support, went through it like a hot knife through butter, and went through all the other levels as well. So this one I'm going to leave alone. It seems like there's a bit too much volatility in here for me. The levels, the tech levels, just not playing ball, not looking clean at all. What's your thoughts on this one, Kay?
Yeah, the market really wants to trade the reopening. I've also seen PBOC again took some, but it's small, right? Liquidity out of the market. I think the market really wants to trade the reopening. We've also seen several rejections around 7, yeah, just into year end and the next past week. So I think, yeah, the market is really trading the reopening now. I'm not touching it right now. I can't sell it here. That's one thing. But is it time to buy? And I'm really neutral right now, and I want to see what the market really wants to do with it. I'm not confused. I think this is okay. It's easy to see what the market is trading because as well the Chinese officials are very positive into their holiday week, and travel is restarting. We're seeing many comments from people who are happy that they can come back to the mainland and everything. So there's going to be a lot of expectations built in here. On the other hand, you're looking at overloaded hospitals and crematoriums, unfortunately, over there as well. I would say if we start to get back through the 684 on the top side, then the correction may be over. But I'm not going to touch it here.
Yeah, no, I'm the same. When you see, I was looking at 684 as a potential place to go long. I'm glad it happened when I wasn't at my screen, because I might have tried a long there and got absolutely carved apart. We are trying to get back into this 679, 680 area. We had a break, as you can see there, a fairly decent level I had marked, highest 78s. We're back above there, trying to build a bit of support there at the moment. So it could be that's our marker for the downside for now. But yeah, it's not one I want to trade personally myself right now. Right, I'm going to hand the charts over to the guys because I've got another meeting I've got to jump into. So I'll leave it with you chaps for the rest of the show, and I'll see you all tomorrow. Okay.
Rainbow time. Thank you, Ryan.
All right.
No, see you in a bit.
Okie dokie. Thanks, Ryan. Right. Still, do you want to me to look at something in particular, or shall we just do a quick runabout?
I don't have anything in particular, so if you have a couple of things to show, then that's fine.
Right. I'm just going to have a look at the Q&A. Charlie, Aussie, yep, Ryan already commented on that. Aussie Kiwi, yeah, Aussie Kiwi is completely sideways, right? Now, so I was saying about this euro dollar. Again, I think we could just hang around. It's going to move on the back of the dollar, but it might just hang around in this zone for a while, and the rest of the dollars trade around it, and euro crosses. As we can see this morning, and I will show you, sterling has had a little try lower, but it's starting to bounce again. Yeah, so for me, this area, it's still the same, right? It's going to be a big one. And on the downside, as I was saying earlier this week, and also on last week, and also on F.A.C.E, we've got a bit of a 105 something going on around 105.10, and then around the 104.5 zone. This is going to be the big one. I think if it goes back below 104.5, there's more to come. But right here and now, I am very neutral on the euro, and it depends on people's view on the dollar, what you want to do with this euro dollar. Personally, I don't do much with it myself.
Sorry to interrupt. I personally think the euro dollar is going to be the big trigger is going to be on Thursday, and I have a feeling that the reaction on a stronger number than expected is going to be a lot bigger than the reaction on a weaker number. So we're expecting CPI to fall, what is it, 0.5%, 0.6% from the last print. If we get anything near that or at that drop, I think that's going to be bearish for euro dollar, so bullish for the dollar. I just feel that the way things are so stacked one way, it means that the pain trade is for the dollar to strengthen. So just my 2 cents.
Yeah, I agree, and I think one that could be really undergoing the laws of gravity if we come out with a stronger CPI on Thursday or so is going to be the cable, because we're capped in this traffic zone. Yeah, we went a little bit above 120, 140, but now we are like gradually losing a bit of steam again. We did go up through this on the dollar weakness. We did go through the 120.70, had a quick run up. It's again 120.65.70. If it starts to go below there, I'd say be careful, because that could be an accelerator for a bit lower levels. For the rest, I think it's going to be the case of crosses as well. This euro sterling, I'm trading it in and out, as people know by now, from the long side. We had a quick try out below here, but we are already back above. The big danger zone is still going to be around 87, 86, 85, 87, and then in between we're already building support levels left, right, and center. So we're back above 88 right now. But for as long as we are below these 89, 10, 20, I will continue to let some go on the way up and buy back on the way down. We shouldn't be trying to be smarter than the market. Just trade what's in front of you on that one. I think this yen is interesting. There was every reason for dollar yen to come off again, because all the dollars got sold off. We went briefly through this 134 and a half, but then we stopped dead on the 61.8 around 134.80. And I was always saying, like, okay, if it goes through 134 and a half, watch the close. So we went briefly above, ahead of the data, and then the close was below. So now this 134.50.80 is still going to be a big one, in my opinion. But on the downside, we are holding around the 23.6 and around the prior lows as well, around 131 and a half, and the prior spike here. So we're basically in a 3 big figure range. But where it was interesting to see the dollar yields sliding, we couldn't produce a much lower low here. So I'd respect this 131, call it 40.55, and give it a few algo pips as well. But I think this level in here is pretty interesting. So if we would get a gradual move back up, look at 132.80.85, 133.80.85 in between. Those can be intermediate stations. But to me, we are now in a bit of a ping pong range here. And we'll see what tonight let me kill my squawk. We'll see what I think it's tonight. It's Tokyo CPI. So the Tokyo is big enough to be representative of what's going on in Japan. Of course, the capital, it's about somewhere 25-30% of Japanese GDP, I think. So keep an eye on what the Tokyo CPI is bringing tonight, and keep those levels in mind. If ever we get back through this 134.5, 135, there may be more to come. And if I recall well, Gregor is also looking at this 138, and this to me is going to be another big one if dollar yen makes it back through the 134.5, 135. This one is relatively interesting, I'd say, and I think some of it is ECB related. We had the big fallout down to those 137s. That was the prior low as well from September, and now we are gradually trying to make our way back up. So I think there's still some ECB Bank of Japan divergence. The data in Euroland not really collapsing, I would say. The support of the lower energy prices for Europe as well is probably supporting the euro, and this is to me an interesting pair. Tried a bit of a long, but I'm really doing it on a scalp basis. But I wouldn't be surprised that sooner or later we'll make it back up to 143. The rest, yeah, the Canadian dollar had another very strong labor report on Friday. Not only did we see 100K job creation, but unemployment rate fell, and where I would have expected it to be more temporary jobs into year end, most of it were full-time jobs. So the dollar CAD broke down through this 134.5 as well. We are trading around 133.80.85. I'd say keep an eye on what's going to happen here. 133.60.65, 133.40, and then there's a bit of calls here to see if we would be on inside a bigger triangle, which could eventually lead us back to the November lows. But we will have to see what happens on the CPI on Thursday out of the US for this dollar CAD, of course. An interesting one, and that's the only pair where I would go like, yeah, maybe this has a bit further to run. If you want to take the dollar out of the equation, have a look at this euro CAD. This could be perhaps the only CAD pair together with the MEX, maybe where I would look perhaps more a little more downside. For as long as we are below 143.40.50, this looks to me a bit fragile, but we need to get closers, and we didn't get one here on Friday after the jobs report, and then the ISM in the US sent the euro crosses higher again, and 142.65. We are in the middle somewhere around 142 to 143 the figure. So keep those two levels in mind, I'd say. One in the short term, 143.40, 142.65. If it goes back down and it holds, we may be on our way to 141.5. Gold, strong, yeah. What do you think, Stel, here? It's pretty strong, right?
Yeah, it's trading better than silver. Okay, maybe today they're up the same, but it has been it's shown much shallower dips than silver, and it's still trading well. Yeah, I mean, you know, it's looking strong. I have my reservations ahead of the CPI. That's why I'm not going all in silver yet. But I mean, they're trading well. Yeah, you
Yeah,
have to admit.
I think some part of the reason is this report coming out out of China, where they again bought a lot of gold in December, right?
Yes.
And that's likely the one that helped it underpin as well the market saying, oh, if China is buying gold, it's a free ride. But I'd agree with Stelios. Of course, the 1900 here is going to be a big level, but keep an eye on what's happening around 1855. 45.55, 1845.55. That's the support to watch. I think if we get back down, if ever we start to trade below 45, we could have a quick move lower down to low 18s. So keep an eye on that one. I don't have anything in it. I'm a bit reluctant to ride the China train because the demand could dry up from one day to another. We never know over there. Silver. Yeah, it's less. They're buying less of it, so silver is less buoyant. But we have seen this. We have been talking about this channel for a while now. This is still going to be the level 24.5, and on the way down around 23, 23.30. We should find support, and I think we are going to ping pong a little bit, and then wait for Thursday's CPI to come out and tell us what people want to do with this. Yeah, the rest we've quick look on the mix. Dollar mix is looking offered still
heavy.
For as long as soon as we went out of this this flag, it's just gone. It's just heavy. Of course, it's a 10% currency. That's what I'm always saying. It's extremely hard to be short MEX for a longer period, especially as well that Banxico told us last week that they likely are going to raise rates again at their next meeting, and things are going. When I look at the data, there's nothing really alarming coming out of Mexico right now. So I reckon rallies are probably going to be sold in the MEX pairs. An interesting one is going to be Euro-MEX. Again, we're turning around this big red line. It's now starting to lose a bit of its importance, but keep an eye on what's going on. If we make it above 2050 again, we've got this prior low here. If we start to find resistance anywhere between 50 and 60, I'd say 2050, 60 is the first little zone here on the Euro-MEX. Goes back below 2030, I think then we can hope or perhaps see that, more rather like that, perhaps see another leg lower. And for today, that is about what I would be looking at. Unless you want to look at anything else, Stelios?
No, I'm good. I just want to have a comment.
Yeah.
Bran wrote, tinfoil hats say Russia and China are trying to start some gold-backed currency or crypto or whatever. There's a lot of that kind of stuff flying around. And I have to say one thing. If any country wants to back its currency by something real, then they'd better not be making deficits. And because you're making deficits, it's unsustainable. So which country can do that? None is the answer. Or maybe Norway can do it.
Yeah.
So, if you have a fixed money supply, you just cannot be running deficits because you're going to go bankrupt straight away. So, but yeah, there's a lot of that flying around, and definitely China and Russia, they're accumulating gold. That's, I think, a given. What are they going to do with it? I don't know. Anyway. Yeah.
It depends. But the thing is, they won't be accumulating it now and selling it out tomorrow, right?
That's true.
Probably a buy and hold in their case.
Yeah, I mean, where's the argument against having gold as reserves for a country? I don't see any argument against it. So it's good to have some proportion of the reserves there. Yeah.
Yeah.
So
I agree.
it makes sense.
It does absolutely.
Cool.
Okay, quick look at those. As I was saying, we're back pre end of year rally in the US 10s. Overlay it with dollar yen. you nearly find it back again. And the yen recoupled somewhat to the US 10s, which is kind of logic, right? Because it's the instrument that they are watching the most. Short term, again, 355, 360, and then well, this one is watered down now. And then look at what's going on if we make it back 370, 373 on the US 10s, and keep a close eye on it for if you trade dollar yen, right? And that's really it for me for today. Thanks very much, Dale. Thanks again, Ryan.
Thank you, K-Man. That was really good.
We call it a day here. Have a great week,
sir.
everybody, and stay safe, trade safely.
And we'll see you soon.